But before I get into it and hand things off to this incredible panel of doers that we have here, I just want to say that Climate Week to me is kind of becoming special because I always come away like re-inspired. And it's obviously about the ideas that come up and the calls to action that come up. But even beyond that, and most importantly, it's always the people. And it's you people and just come out, and it's just like to be around people, have these conversations. You come out of Climate Week like reinvigorated, refired up to kind of dig into things. And then the doers and the entrepreneurs and the creators are also like when you sit back a week from now, you're thinking about something you learned from someone that they're working on, and you're just like, how'd they think of that? How are they executing that? You're just like blown away. And it's super impressive. So I will say this year's Climate Week is different, has been kind of a little bit of a theme. Different in that we sit at the intersection of climate, finance, and tech. So we have a catbird seat to that. In prior years, to be honest, that week later feeling I had was all about like the people doing the projects. I'm like, how'd they think decarbonize that way? How'd they think of that kind of idea? And how'd they marshal the resources around getting it done to sequester that carbon? This year, I look at kind of those three categories, and it made sense to me that in that way, climate's always volatile based on the physical risk, transition risk. You got kind of rising temperatures, you got changing policy. Tech has always moved fast, break things. But finance had been kind of like steady. But this year, finance has been challenged. This year, finance needs solutions. And this year, you have a panel in front of you of people who are addressing that. They're developing the alternatives to keep these projects on track. They are building the bridges. Anyone ever taken, I think it's called the Chesapeake Bay Bridge Tunnel, 17 miles long. It's a long bridge that connects projects to capital. And this group here is 100% dedicated, building first-of-a-kind solutions to deliver what I like to call the connection between project managers and portfolio managers and bringing that together. And I give them the most credit. I was given the definition of an entrepreneur one time. I'll share it with you, and then I'll shut up and get out of the way. But entrepreneurs was told to me one time, someone said, is anyone operating a business or doing work without last year's budget? So there's no times 3.5% here. This is using ingenuity, hard work, resiliency, all those things to kind of bring to market solutions that are going to be more accepted, that are going to bring scale, and ultimately bring a lot more money from institutional finance all the way down through the financial chain to the projects on the ground that need the funding. So it's incredibly important work this year more than ever. And this is the group here in front of us that is charged with that work. So we're transitioning the agenda today. We're involved with a bigger transition that's taking place where I feel like the last 20 some odd years, we've done a very good job of kind of calculating and accounting for carbon and excess emissions in the atmosphere. Now we're at a transition that mirrors the transition we're in today, where we're trying to figure out how are we going to pay for it. And so with that, I will say that is what this panel is about. This group here is going to introduce themselves. I'm Andrew Greeley, been with Triangle for 2 years, long background in institutional finance, and it's a pleasure to have you all here. I'll hand it over to Sean first for you guys to do some brief intros, and then we'll get into it.
Awesome. Well, first of all, thanks everyone for coming, and thanks to Andrew and Darren and Triangle for having us here. I'm kind of doing two things at once. I guess that's somewhat entrepreneurial, but my focus on clean energy is really as the co-founder and board chair of Sustained Energy Finance. So we're the Utah Green Bank. We were kind of formed, as the whole GGRF fund was coming online, as were many other green banks. So we're one of the many de novo green banks that were really expecting greater funding through the NCIF program, which is a component of GGRF. Obviously, that's kind of shifted a little bit. So we are a kind of a startup. We're kind of bootstrapping our organization. We did get some of that funding, which did kind of trickle out before all of the shutdown. But there is now a very large established green bank network that's starting to kind of get wheeled up. looking to raise capital from institutional investors. It's a very interesting ecosystem. It's very well coordinated. So that is a little slice of what these folks are going to talk about, because really the Green Bank network is quite small. My day job is at the firm Ramirez Asset Management. So we're about a $13 billion institutional money manager. I manage the asset-based lending business. So my background is really all structured finance, both on the buy side and previously on the sell side with a few different firms. But we are also part of the Ramirez & Co., our broker dealer. It's the oldest Hispanic-owned investment bank in the country. And we're actually doing financings on the muni debt side for one of the more mature green banks right now, Connecticut Green Bank. And that's a tax credit deal that's being securitized via a muni bond issuance. So the green banks are kind of my project, if you will. You know, the day job is we're trying to help those green banks on our asset management and broker dealer side to get up to scale and have enough capital that we can grow that business. So my focus really, I'm not the clean energy expert here. That's these guys. My part of this conversation is really more about how do we build the financial ecosystem to really accelerate the opportunities to lend money through various green bank projects.
Hi, I'm Lise Wong. I'm with the University of Michigan. I'm a PhD candidate working with Dr. Peter Adrians in his Center for Digital Assets lab. My prior life was a risk analyst in offshore drilling company in the UK, working on the physical trade desk, looking at risk management and carbon management. The research that I'm working on right now, specifically actually, the audience is farmers and how we can incentivize them to adapt regenerative practices and what type of financial instruments we can use to bridge their revenue gap. Because when you have adopting a new kind of practice operationally, there often comes with upfront costs and a lot of finance risk. And so the products that I'm looking into designing and understanding through research is how do we structure assets like carbon that could be sequestered in the ground? How does that translate outside of carbon credits that could impact their book value, their asset, their land asset value, even as a loan term, for example? How do we decrease some of their interest rates so that they're able to carry it in operational loan to adopt these practices without carrying additional financial risk?
Perfect. Jim Rao from Houston, Texas. I'm the founder and managing partner of the Toro Groups. We have 5 regulated businesses, broker dealer, RIA, transfer agent, commodity pool operator, and a Texas insurance broker. I actually have done quite a bit on the energy side. If you look my LinkedIn up, you'll see who I used to work for. But also the CEO of a public oil and gas company, so I can speak to energy. But our main focus is to, and we got into the climate side about 3 or 4 years ago, because if you looked at it, you'd say this is the dumbest thing on the planet. And it's how can you make this better? And we always looked at it from a financial side, a capital market side. And 10 days ago in London, we announced a couple new products on how to do that, all using securities for activities and getting away from what has been a very non-transparent activity. From a background perspective, we have some, I think, some pretty good qualifications. Did the first digital security in the US in 2017, did the first NFT as a security in the world, did the first crypto exchange in El Salvador. We have our own crypto funds, et cetera. So we've done a lot of things on the tokenization side, which we are incorporating into our new product. I don't want to make it a sales call here, but we are trying to solve a lot of issues in one thing called the clean product, which is collateralized liquid environmental asset notes, which are effectively have a detachable carbon credit. Everything's ISIN, QSIP based. We will do it from start to finish in a process that in the voluntary market used to take 3 to 4 months at a minimum. We're able to do it in 3 to 4 weeks. That is full due diligence, onboarding, LOA filing, third-party research report, you name it. So total turnkey activities. We have a very robust pipeline and looking forward to getting a lot of these out in the market here in the next couple months.
It's hard not to sell it when it sells itself, you know, just.
We have the benefit of being fully integrated, so we don't
Yeah.
have to.
No, we'll get into some of that in a little bit. That's.
Sorry if I went too far.
No, that's fantastic. Thank you.
Good afternoon, everyone. I am not a finance guy up here. I am more on the energy side, sustainability side, but a bit about me, and I loved your intro in terms of entrepreneurs. I am the CEO of a company called Water Energy Forward based out of Milwaukee, Wisconsin. It's a nonprofit startup organization that we created about a year ago. Our board consists of members from Marquette University's Sustainability Lab, folks from the Water Council, folks from Pickering Energies, as well as Coral, which is my understanding, the third largest firm that deals in public finance. And so our mission ultimately is how do we help support small and medium-sized businesses in the state of Wisconsin make the transition to sustainable energy. But we came up with that and then we said, well, how are we going to finance that? How are we going to make it work, right? We don't want to take money from the government or anyone else. And so we came up with an idea and a partnership that I'll talk more about in a minute, but of plugging methane wells, abandoned methane wells through the US. There's roughly about 3.2 million abandoned and orphaned wells leaking methane today. Roughly 300,000 of those are identifiable and ready to be plugged. And there's a huge, not only environmental opportunity associated with that, but an economic opportunity as well. And so earlier this year, we formed a partnership with CarbonX. There's a few of you in the room here. Whitney, Taylor, and Steve, if he's still here. CarbonX is one of the leading oil and gas well plugging companies in the US, been doing it for 40 years. And they also have a deep background in emissions monitoring and well monitoring as well. And so through our partnership with them, we are in the process of closing a deal to get financing to build out the proof of concept of plugging upwards of several hundred wells and minting carbon credits, high quality carbon credits as a result of that, and then selling them to organizations who are looking to offset their carbon emissions profile. And I'd be remiss if I didn't announce, we actually just put up, what was the final number, Darren? I think it was 300,000.
325,000 tons.
325,000 tons from a well that was plugged several months ago on the Triangle platform. Credits were minted and just put up late last week. So from 17 wells.
Woo! I was gonna say, that well was spewing if that was one.
Yeah, definitely.
So there's a lot of different ways to do this. One of the things that was touched on before is this idea of kind of carbon capitalism. And I'll just tell kind of a brief story. My background, I ran a fund for 20 years. And the thing I told people when I was running that fund, especially on the marketing side, that you need to be completely aligned with your people who are investing with you. And the idea that in an investor, it's going to take one step closer to meet you halfway is not a real expectation you should have. The idea of that 17-mile bridge that you need to build means you build it from your shore to their shore, and you got to meet them right where they are. And I take this to the next level, whereas we'll talk about you need to be regulated, you need to have good data, you need to be compliant, you need to have all the controls in place that institutional investors need for them to invest in you. Beyond that, when they come and run a due diligence meeting at your office, if they want to see mahogany, you better have mahogany, or else it creates a dissonance, a confusion in their brain, slows them down, throws the whole process becomes corrupted, and they might ultimately do something with you, but it's going to be smaller, it's going to be slower. So you got to be in line with the investor, you got to meet them where they are. And that is what was kind of introduced here. We're going to get into it a little bit further. So earlier today, this idea of carbon capitalism came up, and there's a lot of different mechanisms that fall underneath that are levers or pressure points within inside of a framework, a big, broad framework of carbon capitalism. The one that was cited was kind of the interest rate mechanism, where you could get a higher rate if you don't comply. So it's like a punishing, a stick. But most times, or a lot of times, you find incentives built into contracts, lending mechanisms, and credits, obviously, you're getting paid for. So the idea is you could arrange within carbon capitalism the incentives to be arranged around two different ways. One could be around paying someone to do something, or you could arrange it around paying them for what they did and accurately monitoring how well they did it. So the idea is there's a difference between paying for action, which you might see a lot in the PACE markets, pay people to do something exactly, and then paying for outcome, where you can see any kind of process that's built around the delta. So here's the business as usual case, here's the adjusted case, and then you create the difference between the two, the carbon reduction, you get credited for that. So that's kind of payment for outcome versus payment for action at a very high level. There's benefits and pros and cons to both. So there's no right answer. It's usually a combination, or in many cases, a combination of the two. But with that, I know that Steve's work very much requires high rigor with respect to measurement and reporting of the outcome. So maybe you want to kind of go a little deeper on that?
Yeah, I think inherently what we're producing and doing is outcome based, right? And we've heard that from, the clients and potential buyers that we've been speaking with. They don't want to pay for an activity or an action. They're paying for what are we going to get out of this? And most importantly, are those credits verifiable, high quality, and traceable? And so we've heard that loud and clear over the past year when we've spoken with numerous organizations, big tech firms, and others. They're unwilling to pay just for the activity itself. They want things that are measurable and traceable, and they want it verified by a legitimate third-party verifier registry, as well as a production firm organization such as CarbonX that knows what they're doing and that can permanently plug those wells. The beauty about what we offer and what we're doing is you can do the pre-measurement and you know exactly what's leaking out of the ground, and then you can go through the calculations and determine, what is going to be mitigated as a result of that permanent plugging. And then you plug it, and then at the end of it, you do the measurement again, both immediately after, 6 months after, then a year after, and you can quantify and measure those results. Quite different from, some of the nature-based or DAC emission reduction solutions where, frankly, there's been a bit of a black eye with some of those credits over the years. They're a little more squishy and not as measurable. But with what we're doing and the process that CarbonX has, we know exactly what amount of emissions are being mitigated because of the pre-assessment and analysis that's being done, the post, and then 6 months later, and then 12 months later as well.
Yeah.
And then what that converts to into actual credits. So it gives that sense of security to the buyers that not only are what they're purchasing what we said that they're going to get, but there is that permanence to it as well. With some of the nature-based, there's issues just around the permanence of those, as well as the variability of some of the costs. Permanently plugging wells and mitigating the methane release has a cheaper cost profile as well than doing a nature-based or a DAC solution.
Yeah, I would say the specificity of that data is really a big pro. One other thing that kind of comes to mind with the kind of the paying for outcomes is that it really fits kind of your scope 3 a lot better. So if you're doing in value chain, or if you're doing finance emissions category 15, that's what you're paying for. You're paying for reduced emissions flowing back to you. You're not paying for an action or any kind of outcome. So if that's the kind of engagement you have, actions might get you there, but it's not with the same kind of degree of connectivity to the scope 3 than outcome would. And I'm going to go to Elise here because I think she's got a different perspective on this, and I think we'll benefit from it.
I agree. Like, pay for outcomes pretty important, especially when you are looking at scope 3 and the upstream looking for that value to quantify on their books, for example. But when you're looking at farmers, pay for outcome could take a really long time to establish. We don't have a well plug where you can do it almost instantaneously within a year. For them to actually accumulate soil carbon from conventional farming, for example, when they adopt a regen practice, could take up to 7 years, 10 years, if not more. So a pay for action to kind of get them off the ground is pretty important. So I think products that are being built needs to have a transition from pay to action to pay to outcomes to support that kind of transaction to meet the financial risks that are associated with each stage. So that's kind of where my thoughts are.
I can't disagree with that. So that's 100% true. So Sean, the use of technology, latest technologies that we have available to us today, is that you finding that helpful in designing? Specifically, I'm thinking of challenges around aggregating and providing democratized access to some of these loan structures that for smaller borrowers, smaller projects that might not have had capacity before, not had anyone service them before because of the fragmented nature of the business, and just anything that you might want to share in terms of how you're using technology today to kind of bring new and novel products that are bite-sized for institutions, where institutions will actually engage because they don't have to diligence a million little deals. They could get a big bite into one product.
Well, and just in terms of what Liz was saying too, the fixed income market traditionally, when you price the security, you want cash flow on day one, right? So what you're talking about is kind of more in the framework of like a construction loan, which might cost a little bit more than to prove that you can get to the point of having a cash flowing asset. Right? So that's kind of I think I hear that, and I kind of think about, well, what's the solution in the fixed income markets to make that work? So how do you finance that today? So I'll get to that, but
Okay.
I wanted to ask that
Let
question.
it rip. Yeah.
I mean, it is quite hard. You're still looking at how assets for farmers are being evaluated, right? So like if you're looking at taking a loan, you're looking at collateral, and those are usually their machinery, and sometimes it would be their land. So right now, they don't have a lot of opportunity to be able to bridge that income gap. So they're dependent on subsidies. So
Yep.
grants, it's always subsidies and grants, and you're looking at bridging that. So we're hoping to take that away because the dependence is a lot, and opening it up to capital markets. So you're looking at hopefully looking at a stable bond, a green bond that ties to the farm credit associations that
Right.
allow for this kind of discount maybe at the beginning, and then that's divided up on the scale of the 5 to 7 years, and then bringing it to a regen practice that is sustained yield when it brings the farmer back to the profitability prior to adopting the new
And
practice.
so the trick is trying to get like market rate capital in the
Yeah,
front part of that
exactly.
transaction, right?
Yeah.
So, yeah, I mean, I would tell you that, again, on the Green Bank side, we are in the process across the entire kind of Green Bank network of raising institutional money. The focus has to be on less served markets. I mean, we're all 501(c)(3)s, so we're not trying to imitate what an investment bank is doing. That's already covered. But to your point, yeah, there is a huge need because of the lack of capital in the space to figure out how do we drive down cost to originate, and how do we get to scale if we're serving a smaller underserved market with $1 million transactions instead of $50 million transactions. So, it clearly means that, and if you look at it like the mortgage finance world, the cost to originate, even just a residential loan, is still way too high. It's still multiple points to get a loan originated. And there is a warehouse in Southern California full of about 30 million mortgage loan documents, all paper. It's multiple football fields long. So we're definitely, I think, as we start to transition to how do we kind of make this market more efficient, it's going to be moving to the world of the blockchain and trying to create standardization. And we have to get those costs driven way down to make that a viable market. Simple as that.
Fantastic. I think in that case, it's a situation where not only enhancing, but you're actually servicing a market segment that potentially couldn't have been serviced before. And
Yeah, you look at things like, the CPACE market, where there's 40 states that have CPACE programs. Everyone's a little bit different. They all have different documentation. It's a great program. It's got a great credit history. On a risk-adjusted basis, even though it's a tiny market, it's one of the best risk-adjusted returns in fixed income, but it's very difficult to originate and very cost prohibitive, and takes a lot of time to get a loan done. So, accelerating that, driving those costs down is going to be the way that you really kind of make it easy and efficient for a commercial property owner.
fantastic. Okay, now I'm
On
gonna,
that?
yeah, go ahead.
So we've done a lot of that in our whole process. In fact, I started my own AI company 2 years ago to do these things, right? And so we've driven down the cost of the security side of the equation. we've probably lopped off 75 to 80% of the cost.
Wow.
And that's why I don't tell this in public, but if with perfect data on day one, I can issue all of that in a day. Everything in a day.
Wow.
Now, unfortunately, we have to throw in a horrible variable that's called humans. And once you've got humans, then it goes to 3 to 4 weeks at a bare minimum.
So is that heavily templatized or is it?
Absolutely.
Yeah. Okay.
And so you have to do
Yes,
that. And of course, and I think that is, to Sean's point, that is a game changer going on, but that's everything that's going on right now. And if you're ignoring that, you're already dead. You just don't know it.
Sure.
But the whole origination function is clear. And that's one of the things that we've really worked on hard for the last really 18 months. And that is to get everything standardized, templated, you name it. If there's variability, you do it in exhibits, not in your core document. For those of you in the finance world, it's kind of like that ISDA mentality. Everything's, you already have you don't get into this Mickey Mouse that everybody gets their customized stuff.
Yeah.
Now
Yeah.
that's good for 80, 90% of the market. There's always going to be customization, but then your costs go up 4 to 5 times. So it's your choice. You want to be cute? Fine. I can charge you to be cute.
Well, I mean, I actually think the marketing is easier too. Going back to the point I made earlier about the dissonance, once you create that pattern, people start to expect the pattern, and then on both sides of the market. So it's a marketing edge too as well.
We even do that in our valuation company. We're able to do what used to take 3 and 4 weeks, we can do in really a couple days. And even when we report our data, because we're the data provider to Bloomberg on the carbon credits, I mean, we've got it down to, the efficiency is unbelievable.
Yeah, sounds it. 80% is pretty lights out. It's good stuff. Okay, again, that also opens up alternatives that didn't exist before. When you could get it to that level, you could start to kind of think about things differently at that point, which is really kind of interesting.
Now, look, you're going to capture the great majority. You're not going to capture everything.
Yeah, that's a good kind of way to approach it, I think. Okay, I'm going to pivot from there for now. That was very, very helpful. The next topic that I'd like to get into is kind of holistically accounting for projects and co-benefits. So co-benefits have been kind of like a challenged area in my mind, and trying to deliver fair value for that work to project managers, organizations who are running the projects themselves, I think has been, just something that needs more attention. To that point, shameless plug here for Triangle, we submitted a paper to the LIFT data program for the Bank of Brazil going into COP30 that went through a whole way of using market-based pricing to run it through what they call a risk neutral arbitrage. I'm not going to bore you with it. It's not heavy math, but it's pretty straightforward. But you're able to strip out the value of the carbon credit, the co-benefit attached to the carbon credit, value it relative to a carbon credit. Doesn't have it, initiate a derivative contract that trades against it, and then you have an arbitrage that exists. And you to actually suck out the value of that, get a better price signal from the co-benefit itself. So that's what we've been working at Triangle. I know University of Michigan's been doing a lot lately. I don't know if you want to kick off on that. And I know, Jim, you might have some comments on that as well. So just your thoughts on co-benefits and how to get the right value to the right people at the right time.
It's challenging.
Yeah.
It's definitely challenging, and nothing really packages nicely into greenhouse gas equivalents, right? So, I mean, even on the project I'm working on, we're funded by the Great Lakes Protection Fund, and what we're looking at is you're decreasing the chances of eutrophication, right? And a lot of it is associated with non-point source coming from the farmers in inorganic nitrogen phosphorus use. So there is no direct calculation where I can actually go and say this amount of fertilizer use equates to a reduction in methane, because we are able to reduce the algal bloom that happens when eutrophication. So but should a farmer actually reduce that, your co-benefits is cleaner water. Your co-benefit is economic around the lakes, especially, right? So capturing that value has been something that we've been thinking about, which is why we look at sustainable loans and sustainable bonds, whether or not we can use those to incentivize a farmer to act. And then the co-benefits, as we stack up and you see that eutrophication does decrease, that then increases the chances of farmers adopting because it is streamed through maybe a reduction in carbon. But yeah, it is very complicated to quantify. Another project that the lab works on is using natural-based solutions to address flood within the Detroit metro area. And they're looking at land reform to bring it back to wetlands, right? And community spaces. So how does that work? How does that fund outside of municipality fund? Could we do it through investors? Could you have agricultural spaces like vertical agriculture to bring in community? So community building is a co-benefit through something like a nature-based solution. Could you have outdoor spaces for park use? So like it would be community, but also you can have music venues. So you can actually increase revenue that way so that it's funded through there. So it is more transactional, but it's interesting to see how nature-based solutions and the co-benefits that it could bring is beyond just monetary. A lot of it is community value and social value. When they started with the project, they brought in the entire community, anyone that was within the plan. They were able to brainstorm. Even that in itself is a co-benefit. You're bringing the community together, but it is not monetized at the moment.
Yeah, I mean, I think the work that we're thinking of is if you could kind of disaggregate the contracts that have co-benefits associated with them and really identify the different values, then you have different building blocks to work with. And not to pick up on the Lego analogy before, but I guess it's a theme at this point. If you have all those pieces and they're composable now, then you could start to really design for specific investor groups, specific people who have certain needs, and actually maximize the value to the project itself. So I think it's really important work. I think there's more to do. And Jim, I don't know if you wanted to add anything. It's not unrelated to the carbon warrants, but it's
Well, we're talking about a different kind of benefit. I'll talk to the financial benefits because really my goal is not necessarily creating the standardized financial product. Actually, to me, it's the derivative. Okay, I'm an ex-derivative guy. That's where this is really going to go. But you need to have foundations. We don't have foundations. So you have to bring in the financial discipline and capital markets discipline to start to build that. You can't build derivatives, you can't do the financial products until you have the foundation. It's like building a house on quicksand. I mean, just one of the biggest attributes of creating a security, and people kind of don't really think about this, but you should. And the number one benefit is you now have created an asset. You now have something that can be posted on your balance sheet. Now you have collateral. Okay, where if you did a VCM project, that's just an expense. That's a kind of a wish. You can take that same project, put it into a securities format with all the disciplines of a security, and now you've created a financial asset. You've created collateral. Your farmers can borrow against it. You can do it. Now you have something that you can work with. Let's go to iteration 2. Now you can start writing derivatives against them, right? This is where we've got some stuff already on the drawing boards, but that's where.
Oh, go on, because
I'm not going any further on that.
okay. All right, well, don't go on that. But it is interesting. I totally agree. You need to have the hedge portfolio to have the derivative, and the hedge portfolio, it's got to be a registered, regulated asset. The one thing that's interesting about this panel so far, I just point out that there's some foundational things that everyone here is involved with that we're kind of just skipping over. The idea that we're kind of taking it for granted that, this group here kind of knows it. Maybe we shouldn't. So maybe we'll just, the idea that the data has got to be 100% kind of verifiable, auditable, tracked by a third party, potentially insurable, that you have to put yourself through all the systems of compliance, and you need to be able to plug into the risk management systems of large institutions is like table stakes. It's a lot of work. That's kind of like bleeding edge stuff. But like for this group, it's kind of like understood to be like, that's kind of ground zero. And that's what we're building from. But it shouldn't be misunderstood. I mean, that is the innovation.
That's actually going to be a very transformative thing through also the people that are in this business.
Yes.
In another year, it's going to look a lot more like Wharton than it did, before. So it's going to be very different going forward.
So just give me more on that, because I'm not tracking exactly.
Look, if you look at the history of carbon credits, the kumbaya.
Yeah.
Let's go back 15, 20 years if you know the history of it all. And it's people having good intentions. Okay. I don't give a shit about good intentions. What you have to have is the discipline, be able to have the financial. If I'm representing to an investor, I'm representing that I've done everything in my best knowledge and I mean, verification, background checks, all the kinds of things you do to issue security, as much as I possibly can to disclose and to put up. That hasn't been part of that. And that's not in the psyche of the individuals that originally started in the carbon business and the environmental side. And that's, to me, it's actually been a problem, right? You haven't had that DNA that it takes to get to where we need to go. And I think you're going to see a massive transformative for the people that are in it or have been in it. You're going to see a lot more people that are going to be CFO types than they are sustainability types.
Yeah, 100%.
No one else will say it, I'll say it. Okay, and that's just the fact.
Completely agree. Kind of came up earlier today, this idea that there's got to be a business case. It's got to sit in the CFO's office. Beatrice is here. It's got to be a return on sustainable investment. There's got to be an ROI. It's got to make sense from an investment standpoint. And then it has to have all the controls underneath it.
Gordon Gekko said it pretty well in a movie a few years ago.
It's got to move from the green story to the, financial story. Does it make sense? Is there a business product there that people want to buy, right?
For sure.
And straddling that is going to be key, but it's got to move from just, here's a great green story that makes us all feel good to, are we undermining this with free market principles? And is there, something in it on the back end that someone actually wants to purchase?
100%.
And there's the whole idea of kind of how we're moving more toward kind of a blended finance model. We're kind of trying to get, PRI, foundation, low cost money with market rate money. It's a great way to kind of get things started. But eventually you have to get to kind of market rates so that you can get scale and get the enormous amount of capital, in the institutional investor market into these types of products. So one more kind of comment on just the whole co-benefit. So this is, I think, a tough one. And this is kind of like just the fact that incentives aren't always lined up properly. So I live in Utah. I live in a mountain town, Park City. My homeowner's insurance has gone up by 4x over the past 5 years, but not 40%, 4x, even though there's never been a fire, at least not since 1898. And the reality is that everyone out west, if you live in California, almost up and down the state, anywhere that's got mountains, you are in a dry environment. And wildfire risk is certainly enormous, and the insurance companies are pricing that now. So the question really is, from a state or municipal level, how do they mitigate that risk? How are we going to solve that problem? Because, as a mortgage finance guy, everyone's got low mortgages out there today. But the reality is that your monthly payment has gone up dramatically, and it's mostly due to wildfire risk. You see also utilities that are raising their rates because they need firepower for all the AI computing issues out there. And then on top of that, property taxes are probably going up as well to do some of this mitigation. So it might
mean the municipal insurance, the property taxes are going up.
That's right. Exactly. So, there's interesting solutions out there. Like in Park City, we have snowmaking. We need to get the ski resorts to turn those things on in the summer when there's a risk of wildfires. And can the city actually ring fence the entire town by spending $50 to $100 million to actually build that kind of a ring fence? So those are the kind of discussions that are starting to happen. But who pays for that? Can you get an insurance company to come in and subsidize that? Because now they're going to have a low risk property market to insure. So
it's an interesting mismatch between term, that real estate obviously, but a lot of long-term assets have annually resetting insurance, right? So it's like you consider that like an uncomfortable mismatch usually to be involved in transaction with that setup, right?
Yep.
That you could get run short on the short end potentially that you're exposed to if it continues to go at that rate. It could really change the values quickly.
Yep.
Quickly just add on, even if we bring in insurance, for example, for farmers, if you're able to adopt regen, actually fundamentally it decreases your flood risk. It should actually have less insurance risk. So the
Mhm.
premiums that they would pay for crop insurance should go down. So that would be a co-benefit that could be
Yep.
captured that way. There's just so many things attached to soil organic matter that just needs to be verified properly. And then once that can be minted in carbon, it adds so much value to the farmer's balance sheet, like
Yeah.
property value, for example, right? So
I mean, it's one of the things we've talked about with the well plugging, where we know there are co-benefits with, when you shut down a methane well, we can tell a good story around it, but quantifying that or get to that point where you can turn it into something that is truly accretive to the price of the credit itself is not there yet, or at least we haven't come across that. But plugging a well, you're doing several things. Obviously, the main target is preventing the release of those methane emissions into the atmosphere, but you're also making now that land available for development where it couldn't or wasn't previously. You're also improving the overall ecosystem around that from an animal standpoint. It's helping replenish the prairie lands once that well in that area is cleaned up. It's preventing volatile compounds going into water, so you're improving the water system around it. But quantifying all of that, we can tell a story around it, but quantifying that, I don't think we're there yet. If someone has,
No, it's very much in the future type of thing that needs to be developed. And Jim's point, the markets themselves need to get further developed before you could kind of work the full extraction of the pricing mechanism for those. Because to do it effectively, you actually need a derivative market to help you create the arbitrage against the isolated variable that you're creating. You basically keep creating a risk neutral hedge against the derivative. Let's do a speed round, spice it up here a little bit. So we'll just kind of go, start with Steve down the line. What could help us build this bridge? What piece of technology, what's going to be the thing that if you could, point to that's going to be the biggest lever in terms of a technology, AI, blockchain, maybe IoT and sensors for you. But whatever you think it is, what is going to help us in this transformation? Because it does have to happen, and it does have to happen pretty quickly.
Yeah.
So
I think technology, IoT, all of that, yes. As we've talked about, I mean, traceability and high quality credits that we're talking about is key to not only the methodology, but certainly the confidence of the buyers that are purchasing those credits. And so, CarbonX uses a couple of certified tools today where we can remotely monitor the methane emissions. And then we can also attach sensors to those so that you can also remotely monitor those on a frequent, whether it's monthly, 6-month basis. Those types of things and the advancement in that space will continue to give legitimacy not only to the credits, but then to the buyers that what was done was actually done and it's permanent, right? And so I think technology advancements continued in that space certainly will help give the overall market a little more confidence that what is actually said being done is being done. I think even just like the work we're doing with Triangle and, being able to put those credits up on that platform and having them verified not just by the third-party registry, but then Triangle, and making that available to a much wider audience. Advancements like that, plus the education, will continue to not make this such a second look when they look at you when you talk about carbon credits, but like there's legitimacy behind these.
Tough question for me to answer.
it is a lot.
Because we've already deployed so much of the, I guess,
Mhm. Which one do you think is going to have the greatest impact of what you deployed? Then, like, what do you think is going to be the most kind of
because we've standardized, I mean, we've deployed.
all melded?
We already have
Yeah,
it,
yeah.
right? So I'm trying to think what would be on an incremental basis. But the biggest challenge to me is who are the buyers and why, and how to get better distribution. And anybody that's been in financial services know distribution's your. So for me, it is taking the 25 CSAs that I have and expanding it to 250 commission sharing agreements for broker dealers. So that is those are always the biggest thing. And then obviously articulating we've done and built, and to make sure to
Tell the
really
story.
tell the story and do it better than we have in the last 30 to 60 days. And not to say that we've done a poor job of it. We just, a lot of moving pieces have been trying to go, because we did a lot of this from the private security side of it, because we're the placement agent for Bolivia's $1.2 billion sovereign issue. And if we go to happy hour, you can ask me privately. But we learned, that was a good lessons learned, to get out there and to understand what the market will buy and what it won't buy, and
Yeah.
the tenor, et cetera. So sorry, I'm not answering the technical question, but it's blocking and tackling of.
That's a good answer.
Normally
Yeah.
need to expand on.
I think it's definitely highlights the biggest challenge almost. Yeah.
For us is data aggregation, so standardization. You've got in Michigan alone, like thousands of small farmers. And in order to tap into the market, you need to aggregate that data into a central location. And that data should be shared with their partners, whether it be their aggregator or their banks or their insurance companies, and even with the USDA. This information, if it could be collected, then we have data sets that we can work with and start measuring impacts.
Mhm.
I think that would be really important, and then put that on a blockchain.
These guys already said
You
it,
know,
so I'm
yeah,
just gonna
yeah.
but I'm gonna just emphasize data and standardization.
Mhm.
Again, I'm a mortgage finance guy. I literally can look at everybody's loan and their pay history. I've got millions of rows of data that my quant guy, God bless him, he can spin that and he can forecast based on what a loan is doing, what the probability, if the loan's like delinquent, what the probability is of that loan curing or going into default. And that's literally tens of millions of rows of data, every loan in the Ginnie Fannie database going back 20 plus years. So the ease of accessing data will help the market grow and become standardized and actually have more depth amongst institutional investors.
Definitely grow confidence that it is what it is. Okay. I think we're probably getting close to Q&A. If not, I have more, but why don't we go to Q&A and I'll jump back in if we have more time. Sure.
Just kind of thinking about the comments, Jim just said, rather than technology, we need to think about who the buyers are. Sean made a comment earlier about, the issue he faces in Park City. And when he was talking about that so eloquently, I thought to myself, okay, solve this insurance issue. Who goes first? This room is full of people who say, oh, yes, our intention should be to lower costs. And, Liz, Liz made a great comment about, how it mitigate crop insurance as well. But I guess, how have you guys thought about that whole issue that, panelists have brought up so, eloquently? Where's that demand going to come from? The problem is on the government side, of course, we had, not to get political, but arguably the most powerful guy in this country and perhaps the world said some nasty things about climate change yesterday. So how do we solve that puzzle? How do we find that and get a win-win out of this? Like, do you have any ideas other than what we've covered already?
I think Jim was touching on that point a second ago. I think,
Well,
but go ahead. Yeah, go with
we're
more.
talking about DJT there.
Not political. Say what he said.
If he knew what we were doing and that actually could help him out on the farm bill, you could start seeing, because once we've created something that actually has collateral value that actually helps farmers, and there's some that we actually have done a whole report on actually how you can use trade policy and carbon, and we actually issued that. But so there's ways you can win. I'm not a policy guy. I don't want to get into that. I worked on the Hill. I don't want to do that either. Right. So, but I think but that needs to get to the right audience, because there's a lot of things I'm not going to defend Trump, but he's not anti-environment. He's probably done a hell of a lot of positives as well. But if he actually understood, he's playing to a market. He's playing to a certain audience, right? Okay. And what he needs to do is figure out where there's value buckets. And I can tell you one thing, he's a deal guy. He'll get that done in 2 seconds if he knew it. So
I tend to
we
agree.
just got to get past, what's his name? Lutkin.
Yeah, I mean, the same way.
What makes a deal guy too?
I mean, it's the same way with digital assets. If they start if we're successful in growing the kind of carbon markets, Wall Street gets wind of that there's money to be made. Carbon markets will amplify on
I
that.
can use DJ, I can do.
And then all of a sudden there'll be, all sorts of support
You know
coming
how
out
I
of the
get
White House.
his attention?
Things like that.
Do it all on a stable coin using USD1.
Yeah.
Right? I can tell you one
Yeah.
thing, Trump's,
You like that?
his tune would change immediately.
Agreed.
Yeah, he might
Agreed.
still be uptown. You probably catch him for well done steak.
He might be at the happy hour, no promises, but, any other questions? Oh, he's,
So you guys are such experts and it's great to hear what you're doing because you're at the forefront. But how do we aggregate? Because I mean, what you're saying is so true. And Jim, I mean, I'd love to see your policy paper, but how do we take this and amplify the message? Because you're the keeper of some of the keys for the farmers, for oil and gas. And it needs to move from a small curated group of people to elevate it. And so I'm just wondering how in the room, these gatherings are so important. But now I feel like we're at that time where we could take that.
Well, I think you're seeing this, this was my point
Yeah, but
about
how
going
do-
from CFO to sustainability.
Yeah.
The kids' table is what has been running the show, right? We now need the adult table to run the show.
I think it's, yeah, I mean, one way to say it.
Say it my Say it any way you want, but I'm just trying to get the message across clear is that it's going there and it's going fast because you have to have financial discipline. You have to have the regulatory. And once you have that, then it changes the whole tone. I mean,
Yeah.
it's going to change massively.
I think, if I could say it my way, so the way I like to think of it is that sustainability grew up, the market grew up from the sustainability experts inside the scientists, not from the finance side. So when we think about finance, tech, and climate, it was all climate people who built the market, not finance people. So as finance people start to kind of get more involved, start to make it look and feel like traditional investments, becomes part of the CFO's office, becomes something that they're used to dealing with, fits nice and neatly into their existing systems, into their portfolio architectures, then you're in a different world, completely different world. And Trump will love it. Trump will be behind it 100%.
And I would also just add that, for going to my day job at Ramirez, probably about 10 or 15% of the money that we manage is for social impact investors. And if anything, the demand has gone up over the past year. On the green bank side, with the EPA pulling back, we've seen philanthropic money really come forward. So, I mean, you have to avoid the headlines a little bit, avoid the noise coming out of DC a little bit. I mean, certainly things have pulled back, but underneath, the quiet investors are still focused on it.
Just add a little tiny bit around the academic piece. A lot of like environmental engineers and sustainability academics are pushing these into business schools and like teaching these concepts. So it becomes an underlier within your MBA or even your business degree. And it's one of those things you just kind of have to be part of the business process. And one of the arguments that's done at the school is that sustainability shouldn't sit under marketing or HR. It should sit under the CFO. Like that's how it should be structured internally. And I think that is where the difference will be made. It's just get there.
Okay, I think we ran over. So big round of applause. Thank you very much.